Hey everybody, Preston Bryn here with our trader user group, a weekly roundup. This is for the trading week ending November 4th, 2016. What I've got on the screen here is the E-mini S&P 500 futures, and I really mean it when I say the financial markets have U.S. presidential election fatigue. We're setting some records here that we've seen maybe 5 or 6 times over the past 5 decades. That's 50 years, 50 years. We've had now 9 days in a row of down move, and every day of those 9 days we've had some green on the screen before we closed in the red. We've also had, I believe, 8 or 9 up days in a row in volatility. Now, it's been an orderly move down, meaning we haven't fallen off the floor. We've just been steadily moving lower. And you know, the interesting thing in this move lower is the volatility has probably made a bigger move than the markets. You can see here in just the last couple of weeks right here that I'm circling, you know, we haven't had this kind of move like this that we had on the Brexit or back in February of this year, January, February, end of January, early February, where we've just fell off the table. We've just had a nice, steady, slow drive down. However, volatility is just the opposite. With the volatility, we've moved dramatically to the upside. I mean, if let me just find volatility, I'll show you the VIX. We'll look at that first. It closed today at 22.51, and looking at the daily chart, you can see here with vol, we've moved a lot faster to the upside than we've moved to the downside in the markets. Now, generally, when you have a big explosion like this in volatility to the upside, where you're coming off a pullback and then all of a sudden it just explodes up like that, you're going to see a lot of many days of big, huge down bars, you know, where you open up here, you close down here, then you open here, you move up, then boom, you close down here like that, and then you open up here, you up down here like that. And you just have this huge downward move in the market. But as I showed you on that prior chart, the market has just kind of been drifting like this. But this huge amount of volatility just tells you just how worried the market is. Looking at where we're going to be or where we could be post-U.S. election here, depending on who wins the outcome. Now, it's very similar to the Brexit now, but there are some differences. Let's go back to the Brexit vote in June. If you look at the Brexit vote, same thing. We started off, and let me just kind of zoom down just a little bit so you can kind of see here the comparison. When we went into the Brexit vote, we started off down in this level here. Well, when we went off here, we're right down here too. So we're very similar. I mean, almost identical, right? Same pattern. And then we exploded up higher, what I call zone 3 up here in volatility levels. Now, we did not explode that fast here. We've just had just a nice, steady drip, drip, drip campaign only to the upside. Because you can see here, about a week before the Brexit vote, the markets were kind of compensating and saying, hey, you know, they're going to vote no. So you could see the big rapid sell-off right here. So vol gave it up. It fell from 22 back down to about 16. But it stayed elevated because, again, they didn't know what the vote was going to do. But then about 2 or 3 days before the vote, all of a sudden word started coming out that the no's are starting to catch up with, or the yeses are starting to catch up with the no's, and Britain, you know, could leave, although all the pundits and all the polls said, no, don't worry about it, it's not going to happen. But then sure enough, on vote day, boom, away we went. It surprised everybody, and volatility just took off to the upside, okay? And now, if we're looking at what happened here, we're right at this level right now, just a few days before the election. So there are some similarities in this, although here we've not had a pullback like this, like we had right here. There is no pullback. The markets basically don't want to get caught flat-footed again, so they're jacking up the volatility here that they didn't do before. So it's the volatility is rising really at a faster pace than we're seeing the markets fall. Okay, now if we look at the volatility unvolatility, which is essentially VVIX, you can see the same thing here. During the Brexit vote, volatility and volatility was up in this level here. Okay, in the January February timeframe of this year, volatility on volatility was actually lower than where we were here, even though we had a pretty good pullback in January, February. So it just wasn't reflected in the volatility as much as it is now. And if we come all the way back to the black swan event, which no one expected back here on August 21st, 2015, that was when the Chinese devalued the yuan, and then we had some circuit breakers trip, and then everything just went all crazy for a day or two, and then it just gave it all up, and we came right back down again. This is what happens when black boxes do their thing, and it just takes over the market, and it goes absolutely batshit crazy. You go up and you go down. Now, that could happen again. Anything can happen in these markets, but if you look at the volatility and volatility, and let's step it back out again, you see that we don't stay up at these levels very long. That does seem to indicate that going into our election, we can still take it up a little bit higher. And we can, do a springboard like this. I'm not expecting anything like that kind of move. However, if Donald Trump wins the president's election, the markets would seem to indicate that we could end up in this area up here, possibly up into this area here. It will not stay very long. And for folks that are following in the way we do our credit spreads, this would be an absolute, I tell you, if we get up in this area here, I'll be smiling, because that'll be a time to slap on some credit spreads, because the premiums are going to be through the roof. You could probably go down to like an 800 strike in the SPX, 900 strike in the SPX, and get a lot of premium, where now you're not going to see it. Certainly more than when we were down in this level down here. So we're getting this move in volatility because the markets are a little bit confused. And if we look at the bond market and just kind of see, well, is there a kind of a run to safety here? And not really. The bond market and the Feds are finally in agreement where, yeah, we kind of believe you may raise the rates this time. You can see the bond market has been in this steady move down inside this channel, and then every time we get out of the channel, we move up to the top. But it's basically been honoring this channel going all the way back to the summer months, right? When we failed to make a new high at that point there, that was all she wrote. And then just away we go. And it's a classic trend, right? And if you look at, what's the definition of a classic trend? Well, it's very simple. You're making lower highs as you go down, you're making lower lows as you go down, and you're just not able to reverse that trend, come up, take out that high there, which happens to also be at the 200 EMA, and come up here and establish a sideways pattern. Now that may very well happen after if the Feds come out and do a one and done, then you're going to see I think the bonds kind of enter a stabilization period for a bit, because they will not expect another rate hike for a while, and then they may roll back over again. But I don't think we're going to get back up into this level here, at least not in the next in the near term. The other thing that I wanted to point out in the bond market is we are coming very close to that, what you call the death cross here, which you can see here. The yellow line is the 50 EMA moving down like this, or the 200 EMA. The 50 EMA is moving like that. So probably next week we could get a cross, and that'll be the first time that we've got a cross in the bond market in quite some time. I think we have to come all the way back here to where was it? Oh my goodness, we got to go back to let's see, before we had this cross, and this will be significant, guys. Let's see here, right in this area right here. The last time we had the cross, and that was to the upside, was in May of 2014. And then that's when the markets just started really going crazy. If you look at it, the markets around 2014, we started having the very wide vacillations in the market. And it was also the timing of when, the Feds and Aunt B, aka Janet Yellen, was just serving up a lot of blueberry pie with fat and butter and lard, and the kids loved it, the children loved it, but the markets, they loved it, but it was going to come to an end. So you can kind of see right here this trajectory that we're on right now, okay? And I believe that we're going to probably settle in the bond market somewhere in this area here, and we're going to just stay here for a while. Not until we get more inflation and we get Europe and Japan. Clearly Europe, as soon as Europe starts to take off, there's going to be even more money coming out of the bond market in the U.S. and it's going to be heading back over there. So for now, and by the way, I'm holding longs in TBT. I've been holding them for quite some time, or at least going back to the summer of this year, just playing a little bit of a rise in interest rates. So that's kind of what we're seeing in the treasuries. And then of course, in the currencies, with the British pound, we've been having this bounce, and I've got our members in playing the bounce on the British pound, so we're having fun with that one. So, but let me show you. Let's get back to the financial markets here. Let's get back to the E-mini S&P 500. Even though it finished down 2 points for today, which isn't much, volatility's up over 22, and so it's up. We're in a backwardation environment because the VIX, the spot VIX, is for volatility is higher than the VIX futures. So it suggests a backwardation term structure, which then suggests stress in the market. But I don't need to tell you the market's stressed because you know it's stressed. Now the question is, are these the highs that we're going to see for quite some time? I'm not really sure of that just yet. It depends on who wins the election and how it shakes itself out. But we're coming down close to the opening price of 2016, which is 2037.75 in blue. If I were to take everything off the screen, just to make it very simple for you guys, you can see we passed one major pivot right here. Okay, we just went right below that major pivot. We've got another major pivot right here coming up. 1981, so call it 1980, and that was the Brexit low. And then we got the pivot, which was the low of 2016, which is 1802. So 2100, 1981, just south of 2000, and then right around the 1800 level. I don't believe we're going to see the 1800 level at this time. I do believe that, if Trump wins the election, we could see this 1981, maybe even a little bit lower. I do believe 90 days later, we're going to have a bounce and go back up. I think, and I'm not making a political statement, I'm just looking at the price action and how they react to the poll results. If Clinton wins, we could see a little bit of a bounce higher. I do not believe we may even make new all-time highs, but then I believe 90 days later, the market's going to roll back over again and come right back down where they are. So it's going to be a little bit of a reversal, which is not what everybody expects, but that is what I would expect in the markets, just looking at how price action has been working so far. Okay, you can see also with this volume over price right in that area there, that big spike, right? In volume here, all of this blue, these blue bars represents volume at price. So there is a ton of support right in this area here, down to a low of around 2050 up to the 2100 area. All right, we're going to clearly stay in this area until the election. But again, if Trump wins, I think it'll shock the markets a little bit because they're not expecting it. We'll probably come down here, test this Brexit low, and then we've got, test the lows that we made. The Brexit low right here, and then we'll have a decision to make. If this breaks, we'll look for a retest, but if that retest fails and then we take out the low of the break, then we're coming down and we're going to challenge in a very quick period of time the lows that we made in January and February, or actually February the 11th of 2016. Now the really interesting thing here is, let's say Trump wins. I'll throw a hypothetical out there. Let's say he surprises the markets because they're still forecasting Clinton to win. But if Trump wins and the markets come down here, let's say they really get ugly down here and we get the VIX back up in the 30s, and maybe even a few days in the 40s, and we get global markets react. So we have this global contagion effect. All global markets sell off. There's a flight to quality, meaning money goes into gold, money goes into bonds, those kind of things. Now all of a sudden December 14th comes up and we got the U.S. Fed's meeting. Are they going to hike the rates? I will almost assure you that you will see the probability of a rate hike moving from 70%, which is where it is now, 70 to 73%, down to probably 50%. It's a 50-50 guess. Okay, and then Yellen, who is very dovish, I could see her delaying the rate hike and using the language of the global contagion of a Trump victory. We get that, we'll get a move up only momentarily, and then the markets will take that as a bad sign and a loss of confidence in the Feds, and it'll roll back over again. Now, I just put a crystal ball out there and gave you a lot of ifs, ifs, and ifs, and you guys know that, if ifs had, what, then I don't need to go into that story. So, but I'm just kind of painting you some possibilities. But no matter what, we've got the key levels. They are what they are. 2100, 1981, 1802.50. And this one down here is the low for the year, okay, of 2016. The opening price for 2016, as I said, is sitting right in that area there, which is around 2034, I think, roughly, or 2037, somewhere in that area there is the opening price of the year. We'll come down and hit that real quick, and then we'll go into the red. That's a headline number because the minute the markets go into the red, all newspapers lead with the news the next day, markets in the red, blah, blah. And then it scares people. You'll see vol go up even higher because of that. You'll see a little bit more fear come in. You'll see fear assets go up. You'll see risk on assets go down, and it'll just tumble for about a week or so. So that's what we got to look forward to. Underneath, I think the market is still expanding. I think the economy is still growing, but at a very slow rate. And a lot of this down move here also is taking care of some of the valuations, okay? Because if I were to connect the dots here, that's the channel that we're in. But we've had rich valuations up here. Given the earnings per share, remember we've had, what, 6 quarters in a row of declining earnings per share. I'm not sure what the final print is going to come in for this quarter, but we've got something like that. So by coming down to this area down here, we are adjusting PE ratios. The markets are taking care of it for itself. So, if we enter into let's say a Trump presidency with the markets very low, then I think the downside, while it will still come, will not be as violent as before because the markets are selling off a little bit more than before the Brexit vote. Okay. And then if you look at if Clinton wins, I think the markets will move up, but they're not going to move up too high because then the economic and fundamentals will start to going to come into play, right? And then the Feds are going to tee up December the 14th. Now, what's really interesting to me is if we look at let's go into the NASDAQ for a second. If we look at NASDAQ 100, we started to give it up. We're off at the 2016 highs. But if we look at the Dow Jones Transports Index, we're near the 2016 highs. I mean, it is hanging in up there pretty good, really strong, right? We made highs, all-time highs in the Dow earlier in the year, and then we made all-time highs in the transports. If the markets fundamentally were getting weaker, the transports would be a lot weaker in this guy. So I think underneath the market is really not that bad. And remember what I've always told my members, I'll tell you guys too, that the markets always overcorrect, always, always, always. To the upside and to the downside, the markets always overcorrect. So there's going to be some great plays in this market coming up. The other thing that we've seen is oil has, been pretty choppy over the past month. This has been one of the worst kickoffs in the month right here. If we look at going into the last 2 weeks of October, you can see oil is just falling off the table. It's moved below the 200 EMA. We're coming up to a key level at 42.55. I don't think oil is going to go much lower than this right here. We still got a lot of inventory got to work out. A report came out this morning that North Sea oil is coming back online, which is going to add about 600,000 barrels a day of oil to the already overstocked market. OPEC keeps saying, no, 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 you got to believe us. We are going to cut. We are going to cut. But this chart here seems to indicate that the markets do not believe OPEC. Remember, this move here and here and here was all about OPEC. All right, it was all about OPEC being able to cut, and it's like herding cats. They hadn't been able to do it. So we broke the trend line or the channel. We broke the 200 EMA. So next stop, 42.55. We got some trades going on in oil, and I'm looking for them to do fairly well. Now we got a lot of things going on in the meat market, in the softs market with OJ. And we've also got some interesting plays that we're looking at in the ag business. We've also got gold. Now with gold, I'll do a real quick summation of gold. If we look at the gold market, I've always said that recent up move that we've had here off the lows right around early part of October. So let's just call it the month of October. You can see this is the 200 EMA, and we've just literally ridden. You could probably say it could be like a cup and handle kind of pattern. I'm going to look for a down move here, and if we come back and cross back and take this area out here, I'll believe it, and then we could expect probably a move back up into this area right here. But what may be more likely, however, is a move back up to this level, and then we're going to give it up, and then probably come back down into this area right here. In fact, I was saying around 1200. Longer term, guys, don't get me wrong. Longer term, I'm bullish gold. Short term or near term, I am more bearish. And I think this move here is more fear play going into the election than anything else. All right. So that's a little bit about where we stand right now. It's all about the U.S. election. Hell, we had the FOMC come out today or yesterday. I barely remember what they even said, right? I mean, the markets weren't even focused on it. We're just wrapping up Q3 earnings, and I don't even really know just how good or bad a lot of sectors did in earnings just yet. Why? Because this week and next week we're focused on the election. It really is a crazy time right now. And then we got some interesting elections coming up all across countries that make up the ECB next year, into the fall this year, and then into next year. So it's going to promise to be a very interesting market for the next year or so. And if I swing it out, let me come back out one more pass here, and I'll show you just how crazy the markets have been. And this is ever since the bond market really took off. You remember what I told you? It started right around May of 2014. So if I come in here to May of this year right here, and let's just draw this box right here. This is how the markets have done since May of 2014. Right in this area here is where the bond market just took off and made all-time highs. It just did not stop going down, no matter what the markets did. But you can see these big moves down like this, and very volatile moves, and then bam, up, down, up, all the way back down once, twice, all the way up to the top up here, and now we're working our way back down. Folks, this is a very wide pattern here. It's almost 400 points, but we haven't really established a trend post 2014. It's just been, and I could probably draw it all the way down to this level right here, to be honest with you. I don't need to make that box that high. We did not hold up above our key level here, which I knew we would. We've come back and we've tested it over and over again. So in fact, if I were to draw that same thing here, coming back to May of 2014, roughly, and just draw it in, it'd be just like this right here, right like that. So you can see here that we tried to get up here. We made these highs at 21.91.50, and then that's all she wrote. We're coming right back into our box again. So I believe that will hold to the downside, because not only our lows for 2016, for 2015, 2014, coming all the way back here to 2014 again. So this is going to be I don't think we'll get down to that level, but I do believe we got a high probability of testing that level, which puts us really, right in the center of where we've been for the past 2.5 years. All right. So that's kind of, what I'm looking at here. And if you look at this rounded top, it's a teardrop, right? That's all it is. And that is a classic case. And then boom, we go up, we had fake people into it, and then it just rolls back down again. We go up and we roll down until we've got PE ratios that buyers are willing to accept given the current level of earnings. And then we stabilize, and then we start moving from there based on the new economic data hitting the wires. So that's kind of what I see a little bit longer term, guys. Meanwhile, we got to deal with next week. Coming into the 2-hour chart on the E-minis, you can see here where, again, I've got those key levels. This is a 2-hour chart. And again, we haven't really moved very much, but volatility would give you the sense that we're down a lot, right? A lot. But we're not. We've just been fairly steady, and only since the last 2 weeks have we pretty much given it up and just had a steady trend down, right? I mean, just over the past 2 weeks, we've just been moving in this pattern like that. Otherwise, we've been relatively flat like that. I'm not drawing my lines I could probably make it just a little bit wider, but we've been relatively flat, and then it's, kind of staying like that top to bottom, and it's only been over the past 2 weeks. And the only reason why that we're like this is because of the election. They're not going to get caught flat-footed like the Brexit, and they're going to probably work our way down here. Then we'll go into the election, and then where we go from there, quite frankly, is going to be a toss-up. So for our members this Sunday night, we're going to have a special, just like we did for Brexit, and we'll go look at all the major asset classes across equity sectors as well as commodities, and look at what makes the most sense, right, where you want to be. And then there'll be those asset classes primarily in the futures market that we can trade on Tuesday election night, because I think there's going to be some great trades to take as the poll results come in. And remember, the poll results, for those of you that are overseas, listen to this, they come in East Coast to West Coast, and there are certain states that if Clinton wins, the game's over. So we could get that call earlier in the night. I don't know how it's going to work out, depending on how close it's going to be. Or if it's Trump, it'll probably go all night because it'll be close at every station. So we're going to play it as necessary, and then we will see which way the markets want to go. All right, everybody, members, I will see you this Sunday night, and we will go through all this in a lot of detail. For everybody else, have a great weekend. Remember that here in the United States, it's end of daylight savings time, so Sunday morning at 2 a.m. or effectively Saturday night before you go to bed, turn your clocks back an hour so you'll get an extra hour of sleep for the Sunday anyway. All right, everybody, have a really good one. I will see all of you. You'll hear from me next week. Otherwise, members, I'll see you Sunday night. Take care, folks.